Support for Carolina Business Review provided by Grant Thornton. Operating in more than 100 countries, our tax, audit, and advisory professionals specialize in helping companies unlock their growth potential. Blue Cross and Blue Shield of South Carolina, where healthcare is changing for the better. Find out how at ahealthysc.tv. And by Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services, with more than 300 operations in 35 countries.
2008 almost changed everything. That sounds overused, certainly, and it's also a fairly broad and sensational statement, but in many ways, the economic tsunami of 2008 and ensuing years remade the DNA of many of our business processes. It brought back risk management to center stage and plainly traumatized us emotionally in many ways. Welcome back, and thanks for watching the most widely watched dialogue on business and public policy here in the Carolinas. One sector that is still in large part resetting the way it operates and functioning is philanthropy. How do charitable organizations think differently now? But beyond that, what real lasting change and good has sprung from the Great Recession's fiscal ashes? A meaningful new direction is referred to as impact investing. Harvard Business Review called it the new venture capital. It is the alignment and the deploying of traditional capital with social intention. Is it more than just a subset of charities, or will it become, and has it become, more central to how foundations and endowments operate? We will talk about it in just a moment.
Major funding also by Novant Health, bringing you world-class technology, clinicians, and care when and where you need it. The Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. And by Blue Cross and Blue Shield of North Carolina. Who's responsible for rising healthcare costs? Join us and many others in a candid discussion at letstalkcost.com. On this edition of Carolina Business Review, Deborah McKetty of CommunityWorks Carolina, Tammie Hoy of the South Carolina Community Capital Alliance, Charlie Elberson of the Reemprise Fund, and Susan Daniel of Social Venture Partners Charlotte. Now, here's Chris William.
Hello, welcome to our program. So, impact investing. This is, Tammie, you're closest to me, so let me just start with you. In the beginning of the century, there was a lot of talk about the triple bottom line. Corporations were very hot on measuring their economic, their environmental, and their social performance. That went on for a few years, and I don't mean to say it's still not important, but it was really a hot topic for a while. 2008 came along, kind of reset the economic landscape, and now here we are talking about, at least on this program right now, impact investing. What is impact investing? Is it going to be the new core for philanthropic management or deploying capital? Is it part of a charitable organization? Is it meant to bring in for-profit corporations into doing well and doing good? What is it really?
I think it's all those things, Chris. I think it's doing good, making good while making a return on doing good. So I think it's not unlike triple bottom line, where you're looking at providing an investment to a community economic development need, usually through a non-for-profit organization at the community level that's looking to meet some need, whether that be an entrepreneur opportunity or small business or consumer opportunity, where the individual investor or foundation or corporation can actually make an investment and potentially not only impact change, social change in a community on the front end, but also get a return on their investment.
Deborah, you have a different take on this? Is that accurate, or is there something else to this?
Well, our organization, which is the CDFI, business model is really built around...
And tell me what that is.
It's a certified community development financial institution, certified by U.S. Treasury, to kind of operate as an alternative bank. We work along with banks to kind of fill the needs of underserved markets, folks who don't generally have access to credit, low-income families, minority-owned businesses, folks who are kind of blocked out of the mainstream banking system. So our model basically is which is a real live business model of how impact investing works. There's a network of us across the country of about 1,000 CDFIs, and collectively we have about 30 billion in net assets. So we have a separate industry, and a lot of that is based on the utilization of both debt and equity capital. So a lot of what we do, and banks are a big part of that investment strategy. They invest in CDFIs for a return. And then we, in turn, relend that money to a lot of the disenfranchised communities that we've discussed.
Is there a, and Charlie, Susan, please jump in on any of this, is there a risk, you know, and Deborah, I'm looking at you when I think about the way that you described it, I'm also thinking, as a banker to some degree, I'm thinking, are we at risk of categorizing impact investing and making it accountable? And wasn't the whole part of charitable organizations to do some things without a return, to do them? I mean, the word charity is also interchangeable with love. Mm-hmm. And isn't this about not being able to articulate a return sometimes? So if we're trying to apply a business model to social investing, doesn't that start to go away from the whole idea of being philanthropic?
I don't believe so. We at Social Venture Partners are very concerned that we have a measure, but we are looking at maybe a different way to measure these nonprofits. What we really want to look at is results. Mm-hmm. And we don't want to establish loopholes or that they have to jump through. Mm-hmm. We just really want to look at the results and let the results inform the next steps.
Mm-hmm. And Chris, I would add just quickly on that note that it's also that these charitable dollars aren't necessarily endless. And so if we're looking at a sustainable model for organizations and these capital dollars to revolve, there's nothing wrong with thinking about revolving those funds and making them available in the future. So it's just one other strategy. We're not saying that charitable gifts are not needed and that they're not wanted by organizations, mm-hmm. but this is another vehicle to enable work to be done.
So Charlie, as a benefactor, how does this all kind of flow over you?
Well, it started, foundations like mine started as instruments of social change. I mean, when Carnegie started the Carnegie Fund, it was to affect social change in the world, to use the same business principles that he'd done building steel industry to change things that he cared about in society. To some degree, we're coming back to that from investing in things in this society that we want to see change. And we're in venture philanthropy, and what Susan and I are involved in, we do it in a very business-like way. We name a strategy, we measure, we track, we stage gate, we adapt our strategy based on what we're finding, we invest accordingly. The only thing is, instead of measuring a financial return, we're measuring something else. We're measuring an impact in society.
Well, I'm going to ask you, what is the accountable measure? How do you put a metric to something that's not financial?
Well, that's the fascinating thing. Is what is an impact? What is an impact?
Right.
Well, I have a great definition for what is an impact. An impact is an outcome in context. An outcome in context. The context is what's fascinating, because if it's a financial investment, it's money. Money has its own context. Mm-hmm. It's money. However, when we make an investment, we're looking at something else. We have to define the context for the impact we're looking at. And sometimes that evolves as the investment is transpiring. We may find that when we put school supplies in the hand of a child that didn't have them, it's going to affect not only attendance, which it will, it affects something teacher trust. We can measure that. We can report on it. We can decide how we want to affect and drive that factor. These are all things that are truly transformative for affecting social change. If we apply business principles, sort of go beyond charity and make it more like an investment, we can do a lot more with the money.
So Deborah, where the rubber meets the road at CommunityWorks in Greenville, South Carolina, and you're a recovering banker, so you kind of think in a return type of, are we going to get that loan back?
Absolutely.
Kind of way. But so how do you measure? What's accountability, and how do you measure that the impact investing is working in CommunityWorks?
Well, we apply some of the same principles that you do for banking, at least for our investors. They want to know what our losses are. In fact, that's always a question. Yeah. What's your portfolio? What are your losses looking like? We do, though, have the flexibility that banks don't have to look at alternative ways of for example, underwriting loans. A person who has no credit score, for example, we might be able to look at other ways of getting that person qualified into the finish line and being able to extend credit to them. A micro business startup loan, providing coaching is another way that we can help mitigate risk and making sure that that entrepreneur is going to be able to be successful. So I think it's taking some of those basic core banking and principles of finance, but also applying those in a social application, understanding the clientele that you work with. Just because someone has a subprime credit score doesn't mean that they're not going to pay you back. You might have to look at other factors. They may have a series of medical collections that occurred, but they've been great on their trades. For us, that might be a good credit risk, where a bank wouldn't be able to touch that type of credit.
So Susan, Tammie, I want to answer the same question. How do you, venture partners, I mean, social venture partners, how do you measure forget about accountability, how do you measure a return on the investment?
I would say a lot of the impact work, the social impact work, is also on the front end. So we're really looking for best practices, and it may be with a program or a nonprofit who is making or poised to make breakthrough social work. And those are the groups that we will then fund, and we will work with them 3 to 5 years. We give them our dollars, but we also give them our professional skills and our time and our passion and our community networks to help them strengthen their organization, because that's a lot of where their need is. They're really focused on their mission and making payroll too many times. And we'll help them strengthen their organization and then help them increase their impact in the community. And we'll begin to see that return. We'll see the results.
Does this cause, I promise I'm going to give you a chance to answer this, does this cause any type of skeptical competitive spirit in not-for-profits when it comes to maybe somebody you should be working with, but you're talking a different language, and a traditional 501c3 might not be, singing out of the same page in the hymnal as you are, so they don't know that they want to measure, or they don't want to partner with a venture partner.
That is all true. We will never just write a check, and so there are organizations out there that really are looking for the money, and we come with our intellectual and social capital as well. So we are not for everyone, but for those organizations that are at a crossroads, that are really anxious to, again, strengthen the organization and then scale within the community and beyond, we help strengthen them, and then we go to people like Charlie Elberson and get some funding and try to help them scale within our community and beyond, because we have seen that they are game changers.
Yeah, does this cause?
World.
I'm sorry, Susan. Does this cause a competitive nature between nonprofits when it really ought to be having some type of a bringing together or a convening?
Actually, I mean, what we have seen at the South Carolina Community Capital Alliance is that the organizations are coming together because they have seen that they're stronger together than they are separate. So when we're looking at maybe financial institutions or corporations are trying to better understand impact investing and how they can invest, we're creating a network of organizations that have undergone some due diligence, have sort of accountability standards, and are then able to link up potential capital providers. And so we're seeing more and more organizations are working together because they recognize they can't necessarily do the work on their own. And so in many cases, we're seeing Deborah's organization work with other types of community development financial organizations to get these types of projects and results completed.
And so it's like interesting market forces at play, because foundations find these collaborative initiatives much more attractive for funding. We are much more inclined to fund something where nonprofits have found a good way to collaborate and have established a methodology that is going to be more effective through collaboration. The market is going to appeal to that, so we're more likely to fund that.
So how does social impact, or how does impact investing, Charlie, you talked about funding. A private foundation or a private endowment is one thing, but there's been an emergence of social impact bonds, and that is a way, and I know you all know this, but that is a way to institutionalize to some degree and monetize investing in charitable endeavors or human services or whatever it may be, and do it through the institution of using a bond. Is that a better way to think about this? Or is that an alternative funding source, or will we see more of that? Anyone?
Well, I would just say I think there's going to be a continuum of different types of impact investing. So you have the sort of social impact bond, where it's a much larger vehicle to make things happen. But you also are seeing things like crowdfunding, or investor
like
circles.
Kickstarter, that kind
exactly,
of thing?
where or investor circles, where a group of investors are coming together to identify social need, and then bringing their resources together to invest, or like a Kickstarter or a Kiva, where they're funding entrepreneurs or small businesses. So I think there's sort of this larger spectrum of impact investing, with social impact bonds being one vehicle to make things happen.
And anytime you can get anyone from an individual all the way through foundations to banks and so forth to really take a look at who they're funding, whether it be through crowdfunding or SIBs, social impact bonds. That's a good thing.
Can you get your funding from social impact bonds, Deborah?
I'm not.
Or some
I don't
type
think
of
so.
alternative source besides going to, let's say Bank of America in Greenville to say, listen, we need your help on this. We know you wouldn't make a loan or make the contribution to do this. We'll be the conduit. But is there another non-traditional source of funding for you?
We do have a great tool in South Carolina called a Community Economic Development Tax Credit. That is available, a 33% tax credit to investors who at least invest. Private investors.
We need that.
Yes.
Yes, we do.
That's one thing that we've done right in South Carolina, so we're excited about that. And in fact, we just got it reauthorized and extended till 2020, but it was a great tool for us last year, for example, to raise over $750,000 in additional capital by being able to offer that tax credit. So it's been a great tool for us, and we're hoping to certainly use it more. Haven't had much success with individual investors at this point. We did have one investor, for example, from Charleston, who had a tax liability. I don't know if she was as altruistic and mission-driven as we would have liked her to be, but that was incentive for her. And she did decide that micro-business was something that she was interested in. So we were able to use her.
And not to interrupt you, but so let's talk about that for a second. So investors, when it comes to their own skin in the game, their own money, don't be smiling because I'm going to ask you this question, Charlie, will be much more discerning about whether they want to apply their own dollars there. They get a 33% tax credit, as you said, in the state of South Carolina. Deborah, I expect that your clientele at CommunityWorks is lucky to have you there. But the question I have is does it make good investor sense when you clinically boil it down for investors in the state of South Carolina to be part of that 33% tax advantage program?
I think in her case, not only is she getting a 2% return, which is better than she could get in a CD, she's also got this great 33% tax credit. And then she's doing good with her money. So,
yes, this is where I would disagree with where you started, which is saying that the recession of 2008 was stimulating this. I think it's more generational. I think it's a bigger evolution. I think the generation of philanthropists that are coming up have a really different, more comprehensive motivation. I think they want to affect social change. They want to feel like they matter, so they're more likely to engage with the investment they're making in these nonprofits or these ventures like Deborah's. They want to know that they matter. They want to know they're making a difference. If, by the way, they also get a financial return as well, satisfying both philanthropic and financial benefits, all the better and all the more motivating. But there's no single factor going on here. It's multiple things happening to these people.
Is this about a demographic, Charlie? You say it's generational. Is that about the Gen X's or the millennials saying, you know, we're gonna do this differently?
I think so, yeah. Because I mean, I'm in a category called venture philanthropy. It emerged out west. Silicon Valley money wanted to treat philanthropy not like their dads did, but like they treated their venture funds, like venture capital. They wanted to have business approaches, they wanted to have measurable outcomes, they wanted it to affect change, and they wanted to feel like they had literally skin in the game because they were involved with the investments they were making.
Chris, I would agree with that. I would agree that this generation are looking at immediate opportunities to impact their communities. And I think this is an opportunity for them to do that. I think one of our challenges is bringing some of the other sectors along. So our traditional community foundations and other philanthropic organizations, and really creating educational opportunities for sort of foundations and other organizations to look at this as an investment strategy. But I would agree, I think it is really a movement from the millenniums and the Gen X.
Go ahead, Susan.
Well, I was just going to say, I think the power of meaningful engagement is under-realized and maybe even underappreciated, that in our organization, people actually donate to volunteer. So they laugh a lot saying they are giving money to volunteer. But what we offer them is meaningful engagement. We offer them education. We offer them a plethora of opportunities, whether it be at the 30,000 level of strategic planning all the way down to direct service, where they can really get involved, not just with their money, but with their time.
Yeah, and
they're giving back their professional skills.
And I guess that's the question I keep coming back to, Susan. So you offer meaningful engagement. I like that concept. But does it come down, and I hate to use this term, but it is descriptive, at the end of the day, does the return on the money that they put up win the day? Will they come back to say, I felt good about funding that. I felt good about offering them my in-kind services and leadership or whatever that is. But Charlie, will you eventually in 5 years say, but our return really in general wasn't that great, so I'm going to pull the plug?
Sure, absolutely. Any investment that we make has a fail forward.
So doesn't that undermine this whole idea of social impact investing? Doesn't it always come back to the measurable return of the investment, to as you said, the way to measure money?
Well, we've had several situations where the investment didn't pan out. It didn't achieve the impacts that we set forward, which is why we stage gate them and say, okay, if we have not met our success measures, we're going to adapt or we're going to stop. And even when we stop, there are ways to optimize impacts. We invested in one that helped employ previously incarcerated women. 3 of those women went on to form their own enterprises because of the experience they had. So in other words, what we started failed, but it achieved a really important impact because of the women who learned something to go start their own enterprises. Now, was that a failure or was that a success? Well, it succeeded on one front and failed on the other. That's failing forward.
So it's a good way to put it, failing forward. So the law of unintended consequences is clearly at work here.
And if you're not willing to think big and take these risks, if you take the risk, you're going to have to take the risk to fail. You're not going to make the transformative change that come out of 3 of 5 of them.
Yeah.
1 of 5 of them. Is that worth it?
And a charitable gift, you're just taking the same risk. So if I'm a foundation and I'm providing a grant to an organization to achieve some outcome, I'm still taking a risk. I'm believing that this is going to happen, and I'm hoping the outcome will come to fruition. But this is just another tool in the toolbox to offer organizations, and one that could be a little bit more sustainable than just a one-time gift.
Is there a prohibitive old school mentality in endowments and foundations about participating? You indicated that there was, but I think I'm looking at everyone else to say some of the old line foundations and endowments say, we're going to kind of stick to what we are. That's great that you all do that, pat you on your head and move you along the way. But is it eventually, Deborah, and since I'm looking at you, is impact investing, will it eventually be the core 10 years or 20 years from now, the way that philanthropy is deployed?
I think it will be a part of their strategy, but I don't think we will ever move completely away from just the pure charitable giving because of the way most foundations are made up with your family members. They have their special pet projects. I think that will always be with us. One of the biggest hurdles we're facing is how do we educate more foundations about this strategic work that we're doing, how we're trying to move the needle, how we're trying to solve social problems and use their philanthropy to do that. We've had a wonderful local foundation who's invested over $1 million in the start of our credit union and seeded our loan fund, but trying to get them to structure one of these PRI loans, low interest loans, is just
What's PRIs?
It's a program-related investment, which is an option for foundations to be able to actually invest with a minimal return in an organization like mine. And I think they look at, do they have the capacity, first of all, to underwrite these types of investments? It's just easier to give the money. A lot of foundations just like to fund programs. They don't understand community level outcomes and the work we're doing, and it's just been a real challenge trying to educate, quite frankly, foundations about impact investing. And what it means, and I think for now, for us,
that's going to have to be the last word, Deborah. I'm sorry to cut you off, but we just get the momentum going, and I have to shut us down. I'm like the traffic. Deborah, thanks for being on the program. Susan, good to see you. Thanks for being here. Tammie, thank you. Charlie, always nice to see you. Thank you.
We're done.
Thanks, Chris.
Until next week, have a good weekend. Good night.
Funding for Carolina Business Review was provided by the Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. Blue Cross and Blue Shield of North Carolina. Who's responsible for rising healthcare costs? Join us and many others in a candid discussion at letstalkcost.com. Grant Thornton. Operating in more than 100 countries, our tax, audit, and advisory professionals specialize in helping companies unlock their growth potential. Novant Health, bringing you world-class technology, clinicians, and care, when and where you need it. Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services, with more than 300 operations in 35 countries. Blue Cross and Blue Shield of South Carolina, where healthcare is changing for the better. Find out how at ahealthysc.tv. And by viewers like you. Thank you. Promotional consideration provided by Business North Carolina Magazine. For more information, visit carolinabusinessreview.org.